G'day, Daniel Steen, Select Advice Finance. A couple of key components of finance, especially for first home buyers, and just following on from our first home buyers discussion, are around LVR and LMI. LVR being loan to value ratio, LMI being lender's mortgage insurance. And they work in together because they're risk weighted. So what I mean by risk weighted is, if we look at LVR to start with, the banks grade the risk to them in lending to you based on the value of your property and what you're borrowing as a percentage. And they cap that risk at an 80% mark. So if you walk into a bank, any bank, and you say, I want to borrow, and assume a $100,000 property, and I want to borrow $60,000. And that to the bank is a 60% LVR. The amount you borrow divided by the value of the property. The bank says, what is the risk to us lending to you? And the risk is minimal. So there'll be less paperwork, there'll be less scrutiny, and the bank will more than likely want to do that deal for you. So that next level they look at is 70% or $70,000 against a $100,000 property. And the risk is getting up there, but it's still very acceptable. And once you get to 80,000 or 80% LVR, the bank says, that's it, we stop our risk. So most banks understand that in order for a new home buyer or someone who is buying their second, third or fourth house to be able to get into the market, they need to put some hurt money in. And the bank says 80% is it. Now, it's very difficult to save 20% deposit with today's housing prices. So the bank will agree to go above that, but they externalise their risk to what's called an LMI, or a lender's mortgage insurance. So LVR dictates LMI. They're not mutually exclusive, they work together. Now, lender's mortgage insurance is effectively a risk fee charged by the lender's mortgage insurer for the benefit of you taking that loan from 80% all the way up to potentially 95%. And again, it is risk graded. So the higher you go from 80 to 95, the higher the fee is payable. Now, it's very difficult to have your deposit and the lender's mortgage insurance. And sometimes at that high LVR at 95%, that lender's mortgage insurance might be anywhere between $15,000 to $30,000. So the banks will allow you to what they call capitalise or add the mortgage insurance onto your loan in order for you not to have to find it, in order to make the loan more accessible to clients. So at 95% LVR, there is LMI, because again, we're talking about that risk to the bank. I guess LMI doesn't protect you. That's a very key factor. It protects the bank. So the key here is that if, for whatever reason, that property has to be sold because the payments aren't being made, and it's sold for less than the value of the property, the bank is guaranteed its money, what was owed, and the lender's mortgage insurance then has a separate contract with you to then fund the balance or the outstanding amount. So very, very succinctly, LMI covers the bank. It does not cover the client, but it is a cost of borrowing if you want to go above 80% and don't have that 20% deposit. Okay, so hopefully that makes things a little bit clearer. Again, they work together, they're not mutually exclusive. At 80% and under, there's no lender's mortgage insurance. At 80% and above, there is lender's mortgage insurance, and it is risk graded. So depending on how far above 80 you go, will depend on the policy and how much there is mortgage insurance to pay. Guys, thanks for listening. Just looking at the backdrop here, a lot of first homeowners buying in this area. So if there is a requirement or a need to discuss this further, or you want more information about both LVR, LMI and also first home buyers, you're more than welcome to give me a call. My phone number is 0408 311408, and my website, if you want to take a look, is www.selectadvicefinance.com.au. Thanks for listening, guys.